Hi everyone. Good evening. Welcome back, you guys, to our third session of our free summer program. I am Miss Maynard, and we are continuing from last week's session and the week before that in terms of financial statements. All right, so welcome back, everyone. I hope you all have been going through the recordings, you all getting access to the recordings, and following up with your notes that within these recordings, that is. Before I start this evening's session, I want to find out from you all if there are any questions or concerns. Feel free to let me know through the chat. All right, we have one more week again. One more week before you all go back out. We'll start preparing for, the new academic year. And later on, I will show you all the procedure if you are interested in furthering this subject as one of your choice for writing the exam. You all have the option to register for the academic year 2025, 2026, that is coming September. All right, so later on we'll discuss more of that. Right now, it's to make sure that you all are hearing me. Just checking. You all are hearing me and you all are seeing my screen. Yes, just give me a thumbs up if you are. All right, lovely. Thank you, you guys. Thank you. Okay, so like I said, we are continuing with financial statements, and financial statements never ends in accounts. That is the main thing I wanted to tell you all. It never ends. There's so many statements in accounts that we will have to know for our CXC exam. One of them that we are doing right now are financial statements for a sole trader. Next, we will look at a financial statement for a partnership. Then after, we will look at for a manufacturing firm. And then we will look at for companies and cooperatives and so many more statements you'll have to be preparing as accounting students. And hopefully, when you all get into your big jobs and you become an accountant or working in an accounts environment, these things you all will have the foundation, you'll have the knowledge, the understanding to apply it. Because we're not just doing accounts for just the CXC exam. We're doing it so that later on, when you all start your own business, you all too could do it for yourselves. All right. So, um, questions from last week. Anybody have any questions? We looked at a very simple financial statement last week. Um, we also was able to prepare a little trial balance as well. You were able to tell me which side entries will go on, whether it be the debit or the credit side. We will get more practice, and later on, more practice will come through the past papers. But for now, we are looking at our financial statements, and there's a format. Now, that format is something that you will have to remember for the exam. The examiners will not provide it like how I provided for you all on the screen. You have to remember your format. Like, how you have to remember equations for mathematics, and, if you have to translate a word from English to Spanish or Spanish to English, you have to know it. Well, same thing with accounts. You have to know your formats. So this part of the syllabus that we are continuing with is section 5, which is adjustments. We are now going to see possible adjustments that can take place within our financial statements. What do I mean by adjustments? We have a financial statement. We prepared it. Yes, all is great. But things may have happened probably at the end of, let's say you prepared your trial balance, and some entries would have occurred, right? And instead of somebody going back to redraft this whole trial balance, you will have to now make these adjustments to the financial statement. So what does it mean to adjust? Adjust means you have to obviously change some figures. So let's say, for example, I am the accountant. Oh, no, no, no. Let me just say I'm the accountant. Let's just say I have to pay for rent every single month. $500 to occupy this office space. Every single month I'm paying $500. So January 500, February 500. And for the month of March, I did not pay my $500. I have now to prepare my financial statements at the end of the year. Now be mindful, every single month I have to pay $500, but I did not pay in March. April I may have paid, or May I would have paid, but March I did not pay. So the figure for rent will have to be adjusted, and I will show you all how we do that. There may be a time in the statements when you are preparing your accounts that somebody comes to pay you more than what they're supposed to be paying. So let's just say, let me go back to rent. Let me go back to our simple example of rent. We all know what is rental. Let's just say someone now, I'm the landlord, and my tenants decided to pay every month $1,000. So January 1,000, February 1,000. But for March, they're not paying $2,000. What does that mean? For March, they end up paying $2,000. They paid more or did they pay less? What happened in the month of March? So this tenant, they come, they pay the January 1,000, the February 1,000, right? But for March, they end up paying $2,000. How would you make that adjustment in the financial statement? Or how would you look at that particular transaction in the financial statement? The person, yes, would have paid more. They paid more. What does that also mean? That they also paid for the next month, which would have been April. Y'all see what I'm saying? Just give me a thumbs up if you had that in your that you were thinking that. Thinking along those lines. Yes, it's true. The person, common sense. I mean, you come to me and you give me $2,000 for this month and for next month one time. So you see the common sense. Now let's apply it to the books. So now we are going to get into the theory parts. So these are the first one, the first adjustment is called accruals. These are amongst owing. So it could mean like the same first example I gave you all with rent. I paid $500 for January, I paid 500 for February, but I did not pay for March. That means I'm owing for March. That is what we call an accrued expense because rent is an expense. Rent is not an income. Rent is not an asset. Rent is not a liability. It is an expense. And because it's an expense that is owing, we call it an accrual. We're going to look at how we treat with accruals just now. I just want you all to know the terms now. So accruals could take either an expense side. So let's say, for example, that rent, we did not pay it in March, we owing it, trying to figure out how we're going to pay it off. And then for April, we paid it, but we have to pay for March as well. That's an expense. Did you all know that um amounts that can be owing is not just for an expense? So like we're talking about rent expense. You know, you can also have income owing to the business. Yes, people owe the business money. So accruals doesn't just mean an expense owing. It could also mean an expense or an income that is owing. The expense probably owing, like the rental, or income that is owing to the business. Like for example, let's just say someone is owing you, you perform the service, and let's just say they were not able to pay you for that service just yet. Yes, you may consider them as a debtor, but they are owing this service. They are owing for this service. Debtors are those who owe for goods. Yes? So if you're owing for a service, it's what we will also consider an accrual. So you're probably saying, oh gosh, more terms, more definitions. Will accounts get any easier? Yes, it will get easier. You guys just bear with me here. Accruals, just think of it as owing, an owing expense or an amount owing for an income. So that is accrual. You all kind of okay with the term accruals? And I say the abbreviated term in quotation, kind of okay. You all understand what's accruals? Just give me a thumbs up if you are okay-ish. You know, like to put the ISH at the end of every word. Or like okay-ish, yes? So that's accruals amongst owing. All right. For those who did not put their thumbs up or their hands up, that's okay. We will see some more examples coming up just now. We also now have another type of adjustment, which is prepayment. And think of the second example I gave you all, where the tenant now came to pay me in the month of March. Instead of $1,000, they paid $2,000. Now, I don't even have to teach all you this term. All you already know the common sense. Somebody pay you in advance. That is what we call a prepayment in accounts. So prepayments are amounts paid in advance. So think of the tenant paying more in a particular month to cover for the next month. That is what we call a prepayment. We then have depreciation. That's another type of adjustment. Now you're just going along with me here. We're just looking at some definitions, and I will answer all your questions afterwards. Um, yes, just remember, you guys, everything is being recorded. You all could write a little notes. Don't have to write word for word on the screen. You all, we only have an hour and a half of class. So writing word for word and not understanding what you're writing, it's just deviating you from that whole learning part, right? So just try to understand. You all will get it back later on. Just understand what I'm saying. You can screenshot. Yes, George. You can screenshot the screen, right? Look at this third adjustment that we have here. A very big word, depreciation. Anybody ever heard of that term before? Depreciation? And not just in accounts, like something depreciated. Yes, you all heard of it before, right? Depreciation. Let me see what you're what you're saying in the chat here. Good, yes, you all heard of it. What is it? It is the loss in value of an asset due to wear and tear, passage of time, erosion, and depletion. All these amount of words just describing depreciation, where I can just say, my fixed asset is going down in value. I bought a motor van, a motor vehicle for $5,000 today. If I want to sell it next 2 years, I cannot sell it for $5,000. I might have to sell it for 2005, depending on the wear and tear of the asset. So depreciation is usually for fixed assets. When a fixed asset decreases in its value, it's what we call depreciation. And we're going to learn more about that later on. Then we have another term called bad debts. Bad debts. I know I asked these questions so many times in class, and so many students with their common sense, they like to prove to me that they have common sense. And I hope you all are those other students as well. When you hear the term bad debts, the first thing that comes to mind is a debt that went bad. Somebody owing you money, but they can't pay it back. It's a debt that went bad. we are certain that we will not receive the money. When we hear debts, DEBTS, for those who are not seeing the screen, or might be hearing me saying debts and all, you might be thinking, somebody died. Who died? Nobody died. All here, look at the screen. Debts, DEBTS. That's amongst owing. And when we talk about bad debts, we're talking about amounts that are owing, but just cannot be paid. It cannot be paid off, right? So it is important that you all know these key terms. There are going to be so many more. We just want to keep this summer sweet and short. Yes, short and sweet, simple. All my favorite essays for the summer. These key terms I want you all to be very mindful of. Very, very mindful of. Accruals are amongst owing, prepayments are amongst paid in advance. Depreciation is the loss in value of an asset, usually fixed assets. And bad debt is when you are certain that you will not get back the money from whoever is owing you money. So, question: which adjustment refers to amongst paid in advance? So I switch the screen. You all know the drill. Scan the QR code to the top, or you can go into slido.com and punch in the figures that you see on the screen, 386560. I want to hear from you all. Which adjustment refers to amounts paid in advance? All right. So far the leading answer going to, I'm not going to say it yet. Already seeing it. Yes. Amounts paid in advance, those are prepayments. Accruals are amounts that are owing. So please note the leading answer, the correct answer is prepayments. The correct answer is prepayments. Are we all okay with that? Yes? So, just give me a second. Hold on. I'm going to share back the screen here. I don't know what just happened. Let me just get it back. Right, so the answer to that question was prepayments. Amongst paid in advance, prepayments. Nothing complicated there. So we have some rules. We have some rules that we want to identify here. When amounts that are owing for the current period, they must be added to their respective accounts. So if that rent you did not pay it in a particular month, that means you're owing it. And to account for that transaction, you have to add it. Same treatment will be if an income is owing. So it's not just for expenses. If I had just put, sorry, where's my laser pointer? Right. All amounts owing. If I had just put expenses owing, it's not just expenses. There are income that are owing to the business. And when income is owed to the business, it means that is an accrual. And the rule says that we have to add it to the amount that is in our trial balance. I will show you all how to make that adjustment just now. Second one, we just look at prepayment, and you all give me some very good answers through the poll question. Amounts paid in advance are what we call prepayments. What do we do when we have prepayments? The accounting treatment for prepayments is to minus it from the respective accounts. Hey, you paid in advance. Yes, you might say, oh, look, more money in the business. Don't be too happy just yet. It means that, yes, you got the money from that customer or whoever paid that extra sum of money for that month, like the tenant paid the 2000 in the month of March. Yes, you got the money, but does that, if I had to prepare my financial statement for March, I cannot look at April's $1,000. In other words, I cannot look at what was paid for April if I'm preparing a financial statement for the month of March. That would kind of be a misrepresentation of our financial statement. You did not record it properly. So when things are paid in advance and you want to prepare a financial statement in a particular time period, you only look at what that time period you have to prepare it for. If an amount is owing within the time period, you have to add it in because it's owing. But if you paid it in advance and you're preparing a financial statement, let's say for the month of March, you need to deduct what was paid for April to get a true figure of what we have to account for in March. That's the explanation for accruals and prepayments. In terms of depreciation, we're saying depreciation is for fixed assets, and we are going to consider depreciation an expense. You all, where do I record my expenses? We have done a financial statement already last week. Where did I put all my expenses? Where? Which part of the financial statement? Was it the trading account? Was it the profit and loss account? Was it the balance sheet? Was it my trial balance? Where did I record all expenses? Okay, Nathaniel, I see your hands up. You can message me in the chat. Very good. Ronasha, yes. Expenses are recorded in the profit and loss account, which is in the income statement. So this lovely income statement we did last week, remember there was the trading part to it? Right below the trading part after the gross profit, when we had less all expenses, that's where we record expenses in the profit and loss account. So I have another question. Would you all consider depreciation an expense, a revenue, an asset, a liability? What is depreciation? Is depreciation a revenue to the business? Or is depreciation the loss in the value of an asset for the business? What is depreciation? Yes, very good, Rihanna. It is a loss. It's an expense. It is an expense, you guys. If you all are still, I'm still seeing, no, not in the balance sheet. Listen, yes, we did depreciation in the balance sheet, yes. But to account for the expense in the expense section in the income statement is where we record depreciation. We will come back to that. If you are still confused, don't worry. We are going to see it again and again and again and again and again. In every statement, you all are going to keep seeing it. So there's no way that you're going to get confused. If you get confused, then I will tell you something wrong. Because now, yes, you will still be confused. That's okay. Because this is now our second income statement we're looking at. So I have a rule to tell you all. You see all these rules that I just told you all? See all them rules? Adding, minusing, where to record it? We are following a principle in accounts. Remember, we're doing principles of accounts, huh? we are following the principle of accounts, which is called the matching principle. So the rule that governs all adjustments in PoA, the rule that governs all our adjustments is within this matching principle. I didn't just come up with that just so. I didn't make it up because I felt, I want you all to think I sounded so smart and everything. No, it's actually a rule. It's a principle that talks about all adjustments in accounts. So it's not just me saying this and nobody else. No, this is true. This is legit, you guys. So what does it mean? What does the matching principle mean? This principle states that all amounts relating to the current period must be included in the accounts, and all amounts not relating to the period must be excluded from the accounts. Why does that sound so familiar? Why does it so, wait, let me read it over. This principle states that all amounts relating to the current period must be included in the accounts, and all amounts not relating to the current period must be excluded. We're talking about accruals and prepayments, you guys. Accruals that are owing within the current period have to be added in the current period. But when you pay in advance, like for example, that tenant who paid $2,000 in the month of March, they paid in excess, they paid in advance, we have to take it out. Exclude it from our financial statement, remove it, minus it, deduct it, however you all want to say it. Take it out. Take it out. It is not relating to the period that we are focusing on. So let's just say I want to prepare my financial statement at the end of December. And somebody come and say, you know what? I'm going to pay for the month of January and February of the next year. That's great. At least they're paying on time. And I don't have the headache of running them down to pay me back their money. But the rule tells me that if I'm preparing my financial statement at the end of December, for example, and somebody pay in advance for the month of February and March and April, I cannot record that. I have to exclude it. Take it out. Minus. Didn't we just say that just now? Any amounts prepared, you minus it. Any amounts owing, we add it. Look at back here. So always know I'm not making this thing up. The matching principle tells us amounts that are owing must be included in the period. Amounts that are paid in advance that is not related to the current period have to be taken out, excluded. That's the matching principle. Although go and stand when they ask you in the exam, CSEC exam, what's the matching principle? Or don't be drawing lines and matching things. Oh yeah, I didn't come across that. I just thought of it just now, and I pray to God that never happened. In terms of an exam, and I have to look at that answer. Matching principle is what we have here on the screen. It's not matching a word to another word. No, this is what the matching principle is. We include amounts that are owing in the period. We add it into the current period. And any amounts that are not related to the current period, like somebody paid in advance, you take it out. Are we all okay on that? Any questions? Any concerns? Or they're now officially in accounts, eh? You see Form 5? See how we doing Form 5 accounts? Yes, well, it was in Form 4 accounts, but now we're actually doing accounts. Well, you're in the accounting environment here. This is what you see in organizations. This is how they treat with different expenses and revenues and how they adjust these figures. That is what happens in these organizations. All right. So now you're actually You could say leading up to being an accountant. So that was adjustments that, when we think of accruals and prepayments, and then we have depreciation, we have bad debts, all of those things are adjustments. Let's look at some more adjustments that takes place in the balance sheet. I'm seeing some questions. Uh, Daniela, which part you want me to go to? Just message me in the chat and I could switch the screen quickly so that, uh, okay, which one? All right, so I'm just going back here for those who didn't have the rules. These are the rules. Give me all the 5 seconds. That was 10 seconds. Any other thing that you want me to go back to? All right, so for those who are now joining in, we are looking at adjustments in the financial statements. Adjustments. So now so the financial statement consists of income statement, which is also called the trading and profit and loss account, and we have the balance sheet, also called the statement of financial position. So we're looking at adjustments. Closing stock. You all know what is closing stock. It's the last set of stock, is the remaining stock in the business. Where do we see it? We see it in our current assets. Let's look at B. We already know what closing stock is. I don't even need to go more in depth with that because you all know what is closing stock. The difference between opening and closing stock. Opening stock is what you start the business with. Closing stock is what remain. What is the remains of whatever inventory you had in your business? The last set of stock. That's closing stock. And where does it go? It goes in your current asset. Anybody did not know that? You know, I keep asking, all you're good, but anybody did not know that? Don't feel ashamed to put up your hand. We all here to learn. If you're feeling that shame, you can message me in the chat. Miss Ann didn't realize that was in the current asset. Closing stock is in current assets. Now remember, I don't teach all you like robots, huh? I'm not teaching all you to be applying this just so, just so. I want you all to understand as well. Because it is stock that is remaining in the business, and because it's the last set of stock, please note that it is what the business owns. We have this in our business, but it's very, I'm going to give all the back all the same answer. It's very current. It's not going to last forever in the business. So that closing stock is going to change by time the next month. It might go down, right? It might go up. We don't know. All right. So there's a topic in accounts that we will learn how to account for stock, closing stock, and etc. Those kind of stock later on. It's called stock valuation. If you all did it already, have an idea what I'm talking about. Later on, we're going to learn how to account for stock. Look at B. We now reach B. This is another adjustment that takes place in the balance sheet. Accruals, we spoke about it, where it is an amount that is owing. And remember I told you all it can either be an expense owing or an income owing. Well, look, some more common sense coming your way, you guys. More common sense. If an expense that is owing to the business, or let's just say the business is, okay, let me give an example. You know, I like to give examples. I'm owning a business and I did not pay a utility bill. Let's just say I did not pay telephone bill. That means I am owing telephone bill, right? I'm owing for that amount, whatever that amount is. That is my expense, which is the telephone expense. It's owing. And we say liabilities is what describes owing. Liabilities mean owing. So whenever I'm talking about an expense that is owing, it goes in my current liability section. But if there's an income owing to the business, it is considered a current asset. So let's talk about this one. Income owing, current asset. It means income is owing to us. So let's just say rent receivables, commission receives, right? Income owing means you did a service, you rendered a service, you rendered it, and you didn't get back, you didn't get the money yet. So the service that is owing to the business is called accrued income. So we look at accrued expenses. Now this is accrued income. So as I told you at the start of the session, we have two types of accruals. In the exam, they could bring all two. They could bring one out of the two. They could even bring none. We have to know it. It's on the syllabus. So please understand what is being described here on the screen. The next one, which is C, another adjustment, is prepayments. We gave the example at the start of the session. You paid in advance. I can make I could pay for an expense more in a particular month. It's a prepayment. And how we treat with it, it goes in our current asset. Why is it in the current asset? It's an expense that is being paid in advance. Let me explain to you all why and not a liability, because you all might be saying, okay, let me try to remember, expenses is a liability, it's owing, so expenses prepaid is a liability, or they will be in trouble if all start to think like that. I give you all the examples that I've been hearing of children trying to remember these things for the exam and they end up messing up the whole paper. Not my paper, or they're not my paper, not CXC paper. We're not messing up CXC paper. Let us understand this here now. When an expense that is paid in advance, it means that the business doesn't have to worry about paying it for the next few months. I don't have to have the headache. I don't have to worry about paying it for the next few months. It means that whoever I pay the money to is owing me that service. So I have a service in already. A nice example that I usually try to give, which usually is never the case for myself, is the gym. I know it has some of my colleagues at work who love to pay in advance to go to the gym. And they're always telling me, you could try it, it gives you that dedication to know that you have your money in, so you can't waste it. If you don't go for a month, that means your money just got wasted. So they say pay in advance so you'll know you could go. Yeah, you're dedicated to the gym, etc., etc. It means that that gym is owing me a service. Whatever gym that is owing me a service. So we treat it as a current asset. It means that this is an expense that was paid in advance, but we own it. We own that service. We're not owing nobody because we paid in advance. We paid in advance, so they can't come and tell us that we have X amount of money owing at this particular period. We know this is what is owing to us. So that's why it is a current asset. What is the difference? Current assets, current liabilities. We also have income prepaid. It's a current liability. Income prepaid does not belong to the business until the next accounting period. So we might prepare something, somebody might pay for a service in advance, but that doesn't mean, right, that they are owing the business, we are owing the customer. Or you hear me out, all your, you see adjustments. When I first heard of it, it was craziness. It's a lot being thrown at you at once. But we are breaking it down. Even if I have to take this whole period here to go through this one slide, which I'm not going to do, but I want you all to understand. I'm going it through slowly with a fine teeth comb. I want you all to understand it. I've reached here. Income prepaid. Why is it a current liability? We all know what is a current liability. It's an amount that is owing a short-term liability. It's a short-term liability. I'm operating a gym. I'm allowing my members to make their monthly payments to join this gym, to be part of my gym. And let's just say one customer comes and say, hey, I'm paying for the month of, what month we in? We in August. We paying for September, October, November, December. So they give me the money. So I say, okay, thank you. Thank you. That means they don't have to pay me for September. They don't have to pay me for October, November, nor December because they already paid. So who owing who? The business is owing the customer the service. That is why we call, yes, we got the money. It's an income that we got. It was prepaid because a customer say, I'm going to pay for the whole year one time, the gym membership. But it means that the business is now owing the customer that service. Are we all okay with that? Just take a minute and find out if you're really okay before you give me a thumbs up or message me in the chat if you're not okay. So I'm waiting for some feedback. You can send me the feedback anytime when you all are ready. That you all are okay. Make sure you're not giving me the thumbs up because everybody giving thumbs up, huh? Make sure that you are okay. If you want me to explain over something, message here now. Or forever hold thy peace with accounts. Here now. Yes, Milan, I will explain, sure. Okay, I won't call all the names so that all they won't feel, oh, Miss pointing me on. Oh, no, I will just say, okay, I will. It is a lot to take in. Yes, it is a lot to take in. That's why I say, let me take my time and go through this. I'm going to explain over, oh Lord, who asks? Expenses prepaid. So we're looking at expenses prepaid. So everybody understand. Let me just get all you okay with expenses owing, current liability, because I mean we owing the expense, right? It's what we owing. Yes, thumbs up. Everybody good. Expenses owing is a current liability. In terms of income owing, it's a current asset. I see that you all said you're okay with that. Okay, so I'm seeing in the chat here, most of you all are still confused with prepayments. That's okay, that's normal. So I'm going to explain it over in a different way. Um, expenses prepaid. We say it's a current asset. All right. I am going to pay for no, when I say I am the business. I'm the owner of the business. I am going to pay for let me think of something else. Rent is the only thing that come into my mind. Uh, let me think, let me think. I believe you can pay for electricity in advance, but I don't want to be too complicated because TNT could be well complicated at times. Uh, telephone, telephone expense. Let's just say I am the business owner and I pay for my telephone expenses for the month of January. Every month I'm supposed to pay My telephone is on a fixed amount. It can fluctuate depending on how long I like to talk on the phone. So it's always going to fluctuate. So let's just say, instead of me going through the hassle of trying to remember what my monthly fee is going to be, let me just cover for the next few months. I'm going to pay $1,000. So whenever the bill does arrive, at least I won't have the headache of knowing that I didn't pay for a particular month. Because every month I have to use the telephone. I have to call my customers. I have to call everybody. But where would I treat with that? Because I am making that prepayment to the telephone company, an amount way above my monthly um expense, way above it, I am making a prepayment. Who owes who? The telephone company, or do I owe the telephone company? Which one? Let me see those with a vote. If I am paying an amount way above my telephone expense amount, does the telephone company owe me, or do I owe the telephone company? Also say I owe the telephone company. Put your thumbs up. Okay. All those who say that because telephone company, you can put your thumbs down now, you all. All those who say that the telephone company is owing me. Only look at the participants. Majority of you all have it. Very good. The telephone company owes me because I paid in advance. And because they owe me, because I'm using the word owe, what am I be thinking is a liability? No. I know I have something in. I have a safety net. I already have a service in. It's a current asset. And then for income prepaid, this one here is the opposite. Let me go back to the gym. Hope you're taking some time to go and do some workouts and not sitting down on all yourself eating whole day. Go to the gym. Join a gym, right? You go to the gym and you realize, oh gosh, $300. Let me just pay this month, but what guarantees you that you're going to go back next month? Put your money in the gym for the next 3 months and I'll bet all you're going to want to go because it's a loss of money. Yes, you're paying the gym more money just so that you can secure your commitment to go back to the gym next month and the month after that and the month after that. Hey, go for the whole year. But what's happening here when the gym have to now prepare their books of accounts because we're talking about income prepaid. Yes, they received monies from us, we're the customers. They receive money from us for next year, 2026. They are not going to treat it as a revenue. They're not going to treat it as a current asset. They're going to treat it as a current liability, even though they got the money from us. The whole year they get 2026 monies. I join the gym. Aliyah, you're coming with me. Afia, Aidan, Alexa, all of you all coming with me to the gym. We go and pay for 2026 one time. It means that this gym is owing us a service. And whenever we're talking about owing that service, we're talking about current liabilities. That is why we treat it as a current liability. Yes. And that's everything in terms of prepayments and accruals, both on the expense side and the income side. When we get around to actually preparing the accounts, you will know if you truly understand or not. But at this point in time, let's see what other adjustments take place. Depreciation. Now, there's a whole topic in accounts that we will be looking at for depreciation. Just because it's summertime, I will be going through it very briefly here, but there is a huge topic that I have to explain depreciation to you all. But let's understand what it is first. Just the nutshell of it. Yes, it's the wear and tear of an asset. It is an expense in the business. And we have to record it in the profit and loss account. It's an expense. So just, you see in some words here, depreciation recorded in the profit and loss account. It must be added. It means that it must be in the profit and loss account. And we have something here called a provision for depreciation. Now, you may not have heard provision for depreciation. You may have heard accumulated depreciation. Either words means the same. The both words actually means the same. So another term for provision, let me see if I could make that change here once. Oh Lord, did I stop sharing my screen? Hold on. What just happened there? I think I pressed something by mistake. Accumulate. Well, since I'm already on it, hold on, are you guys? Getting back up the screen here now. Share. All right. So I just put the words in brackets. Another term for provision is accumulated. Like I said, this is a topic, a full topic in accounts that we will learn later on with. But because we're doing adjustments, I brought it in so we have an understanding of what to expect when we actually do see a little question that's coming up to adjust it. So let me just go to bad debts. Whenever we're seeing a bad debt, we have to minus a new provision. Again, for bad debt from debtors. Now, bad debt is debts that are owing. It means that it is owing and we are certain that we will not receive it. Probably the person died, so hence the reason we're not going to get back the money. To adjust it, you have to do this calculation. You minus the provision for bad debt, the new provision for bad debts from your debtor's figure. Now, all of might be asking, where it is coming out from? Why we minus it from the debtors? Who are our debtors? Or what are debtors? Are debtors those who the business owe? Or are those people who owe the business? What are debtors? Or who are debtors? Let me see. Okay, I think you always vote faster than typing. All those who vote, it is who the business owe. That is what debtors are. Who the business owe? The business owes money. All right, the vote is very low. Let me hear the flip side. Put your hands down. All those who say it is customers who owe the business. Ah, thumbs up high, high up in the sky. Yes. Over 20 of you are messaging here. Yes. Debtors are those who owe the business. So imagine if a debtor can't pay off the money. You all can lower your hands now. Thank you. Imagine if the debtor can't pay the business the money. Then we have to minus it. So you see why we have it here? We minus the bad debt figure from the debtor's figure. Does that make any, does common sense come a little bit there? Is there a little common sense in that? I only keep saying common sense because if a customer, which is a debtor, cannot pay off the amount, business means that we cannot get the amount. So therefore, we have to minus it. We can't add it to the data because we keep adding it and we know that we're not getting it. What's the point of adding it? We have to take it out from the debtor's figure. So that's the reason why we minus it. We will do that just now. So I'm seeing a message here in the chat. Uh, uh, yeah, CJ, it could be businesses. Once you are owing an entity, if a customer is owing an entity or if a business is owing another entity, that's a customer, that's a debtor, right? So it means once somebody is owing, yes, to whoever the debtor is the customer, all right? So accounting entries for those debtors, which is under the bad debts, we have something called a provision for bad debts. These are amounts set aside. Now, although this is a new term I'll be coming up here with. Provision for bad debts are amounts that you will set aside out of your profits in the event a customer cannot pay you back that money. We're speaking about um in the event that customers cannot pay us back the money, we have to account for that. And to account for that is a provision for bad debts. So let's look at it together. I have a customer named Jack. Now, Jack, I can't tell you much about Jack, but one thing I could say is that sometimes Jack does real mislead me. He will sometimes come in the business 1 month and he will pay for whatever service, he'll pay for his goods, and then the following month he will say he can't pay me back the money until the next few months. He went bankrupt. So he comes the next month, he gave me back the money. So I said, okay, let me just keep him as a customer. He come back again, he buys something and he can't pay me back it. So you see, like people like Jack will give me a headache. People like Jack, I have to put something in place for. It's my weapon. And no, it's not a gun. It is not anything like that, you guys. I'm gonna create a weapon. And that weapon is called my provision for bad debt. In the event Jack come back again and say he can't pay me back the money, I put something in place for people like Jack. So when they come, they buy their stuff and they can't pay me back, I am basically creating a safety net. I'm sure you all have safety net. If you're traveling to school or you go and buy yourself something in the cafeteria and you realize you have no money in your pocket, you're looking everywhere like, oh gosh, I forgot my wallet home, I forgot my purse home. I know some of them might keep all the money in the back of all their phones. Like myself, I just have my my little security money. I somewhere in the corner somewhere in my phone case. I just have a little money at the side because you don't know what can happen. That's my safety net. I don't know where all the safety net is, but people have safety net in case something does not work out. I have a backup plan. That is what we are talking about here on this screen. A backup plan for people like Jack. They can't pay me back the money. I am going to put aside some money in my business because at the end of the day, I have money to pay people. I had to pay my workers. I had to pay some creditors. I had to pay back the bank for the loan that they gave me. And people like Jack coming to take my goods and I don't have money to pay them back. I'm going to put aside some money from my profits in the event people like Jack come the next day. In other words, I'm creating a provision for bad debt. I'm putting aside monies to cover future possible bad debts. The amount set aside, I'm reading on the screen, the amount set aside is usually a percentage of the debtor's figure. And the last sentence, this provision represents amounts that we believe may be bad or uncertain. So we believe that a reoccurrence could take place. Hey, you might go to the cafeteria and the next day and you forget your money again home. But I had some change from the phone and in case I know I just do them thing. Right? So, oh God, Gabriella, sorry, I'm not going to call your name. I already did. Yes, put in your shoes. Put, I don't think that's sanitary, but you could do that. Put your own safety net somewhere. Look, another person saying they go put in their socks. Or it doesn't matter where you do it or how you do it. Have a safety net. Don't think about just accounts here. In life, you need a safety net. Hence the reason why you're getting all the PoA distinctions in the next few months. All you know, you could go and apply for some jobs afterwards. You have your safety net in. Yes. Accounts is the leading. Yes, just know when you do your accounts, you get your distinction, you get you with something out there. So bad debts, we are certain that we will not receive it from our debtors, and as a result, we write them off as a loss to the business. But because we have a safety net, we don't want to hear losses. I had some money put aside for my profits. Remember the 5,000 profits we get last month? Yes, man, I put away 4,000 from it because I know this customer would have take my goods, use my goods, and they can't pay me back it. I already put it aside. I put aside some money. Don't worry. Don't worry. Right? But what we have to now worry about is how we account for those transactions. That is the mission. That is the aim of this whole session. So we have some entries that we're going to be looking at here right now in terms of accruals, prepayments, depreciation, and for bad debts. Now, just looking at this screen, because you taking out money for delinquent customers like Jack just being a real delinquent customer, he just keep playing with my head. Because I have to put aside some monies from my profits, provision for bad debts is treated as an expense to the business. Why I have to put aside my hard-earned money from my business for people like Jack? Why? Why? But in the event that they can't pay it back, at least I knew, thank God I did. Because now I had to explain to the bank. I don't know how to explain to the bank when I can't pay off my loan. So, a provision for bad debt, somebody write it somewhere. Write it on the screen, write it on your phone, write it in your notepad, wherever you're listening to this. A provision for bad debt is treated as an expense to the business, right? So, we have some accounting entries that we will look at just now. If you have to increase your provision for bad debt, you're thinking that, all right, I had $5,000 profit, I put aside 3,000, but you realize I was just too little. And I put aside some more. That means I have to increase my provision for bad debts. Where could I use that money and go on a little vacation? No. When I increase it, it means now I have to put aside more money. It's going to increase my expense in the business. But you all look at the last point. This is the happy side. I'm smiling here in the last one. Why am I smiling? Why would a business owner be smiling in this last situation? To decrease a provision for bad debts? Think of it. I am decreasing my safety net. I realized that my customer who said they couldn't pay now called me and said, hey, I get some money. How's some money for you? I could drop it off? Well, yes, come true. I'm I'm happy, I'm smiling. I am going to now decrease my safety net because this customer is paying back the monies that they owed to the business. The customer paid back monies that was owing to the business, and therefore I am getting money. Guess where I will put that? Guess where? I'll put it in the business, but guess which part of my financial statement in the business I will put it? I would add it to my gross profit. Well, yeah, when I decrease my provision for bad debt, a customer coming to brighten up my day, they're coming to pay me back my money. I am going to quickly run with this money and add it to my gross profits. Right? So, you all, these are just a few adjustments that we are looking at here. So let's get down to some real business here now. Real PoA. Not that we wasn't doing real PoA just now, but you know what I mean. Let us look at some questions with financial statements with adjustments. And I'm going to leave you all with something to do in class, a little activity. Sorry, not that. Sorry. I'm showing already the end already. We ain't finished, huh? Oh, yeah, we ain't finished. I'm just going a little too fast. I'm clicking, and I need to share my screen here. Let me share it. So let us do this activity here. Now, if you all have your Frankfurt textbook, because you all in Form 5, if you all never had a period textbook, well, yeah, it is recommended that you all get a textbook. And I recommend the Frankfurt textbook. Well, you know the Frankfurt textbook, it could be the 5th edition, it could be the 6th edition. Daniel, it depends on what gym you're going to. Sorry, I just answered a question from Daniel. It all depends on the policy of the gym. But if you go for only 3 days and you want back your money, well, good question. It all depends on the gym. All depends. Yes? Let me see what other questions are coming in the chat. Alicia, you can use the 3rd edition textbook. Wait, you have that? You have that, Alicia? You have your 3rd edition? On your, yeah, all right. Well, yes, we can, except that the question number will just be different. So if you are using the 3rd edition textbook, the 4th edition, the 5th, or the 6th, the question number will be a bit different in terms of the chapter number. But the question itself is the question. The format of the question, the requirements of the question are going to be the same. All right? So, all I get all your hands on a textbook because you see from September, yes, the textbooks is what we will be using, but for us to practice, you need your textbook as well as, your past papers will be provided. Talking about that, before time runs out on me as usual, because we have so much to do in accounts, just give me 1 minute, you guys. Next class, I will be talking to you all about, registration, because all your next week is the last week of free summer classes, right? Free summer classes are going to be ending around next week, please God. If I'm not mistaken, is that the 4 weeks? Well, yeah, the 4 weeks, I think, yeah, right? When you all are ready to register, just remember you have your flyer. If not, if you all didn't see the flyer before, I'm just going to share it here quickly on the screen so that you have your information to contact to register to get access to the Google Classroom, your past papers, your textbook. Yes, for those who are asking me in the chat, yes, the soft copy of the Franco text will be provided, but I want you all to still have it. I want you all to know that every class moving forward will be, yes, online. We still considering the physical class, so you can let me know with this number here on the screen, 868-782-2492. You could message this number if you have any questions on any of the packages that we have, what will be available, times, even the place. Just know it. Yes, it's online, but if you're considering the physical, you can message me on on this number here. All right. So this is just the packages that we have for after. This is after the free lessons. Remember the free lessons we need for the summer, right, you guys? So if you didn't know, now you know. So that is from September. And you're lucky you're getting a whole week extra. So I'll let you all know when you message me this number, right? Screenshot it, you know how you like to screenshot the flyer, you guys, so that um you all could get sorry, that's a wrong picture. That was on my screen, sorry. Right? Let me just share back my screen with the Excel sheet so that you all will have it. We are looking at this question. You have my number. If you need it again, I am messaging here, you all in the chat. I have too many things on the screen, you guys. I am going to message my number, 868-782-2492. And I'm going to put my name. If you all have any questions in terms of registration for September, it's in the chat. So you all have it. Let's get down into the business here, which is this question, which is from the textbook. It is J. Jordan. So if you're using the 5th edition textbook, it's chapter 26, exercise 26.11. You're seeing it here at the bottom of the screen, 26.11. Or if you're using the 6th edition textbook, you're doing 28. You're on chapter 28, 28.11. X is the exercise. All right, I just put this here for you all so you all can remember accrued expenses or liabilities, income. I just put it at the side so we could all remember which part of the balance sheet it will go. But our exercise for tonight, because you know I like to leave whatever a little exercise to do in class here now. We have some items. I'm highlighting them. And we don't have no figures. So I am going to give you all the figures and you all are going to message me here in the chat. I hope all you can message real fast because we're doing this exercise now. You all are doing the exercise and I'm going to get the answers and I'm going to tell you all if it's correct or not. We have an item called discount allowed. And let's just say the amount is 410. Let's just say it's $410. Where would I put it? Would I put that $410 on the debit side or would I put it on the credit side? Where would I put it? Okay, so the first answer that I just saw was Ronasha. You are absolutely correct. So Ronasha said that discount allowed of $410 will go on the debit side. Excellent. Ronasha. How do you get accustomed to all your names? Well, later on, yes. It will come to me naturally. So for those who said debit, yes, TJ, you're correct. Everybody, yes. Good. Correct. Why is on the debit side? It's an expense. Discount allowed is an expense. I'm allowing you a discount. I'm not going to get my full money. I even get a profit. I'm allowing you a discount. It's an expense to the business. But discount received. Let's just say the amount is 506. $506. Let us not worry about the amount. Where would I put discount received? If I have it in my books, where would I place it in the trial balance? So I'm extracting the trial balance with your help. So expenses are debited, which is discount allowed. Discount received, which means I'm receiving a discount. It's a revenue. If expenses are debited and the opposite of an expense is revenue, what would I do? Debit or credit? All those who say debit, put your hands up. All right, nobody. All those who say credit. Excellent. Good job. So, discount received is credited and the amount is 506. Carriage inwards. That is goods coming into the business. That means you're purchasing your goods. That means you have to pay for your transportation to get the goods in the business. All those who say carriage inwards is credited. All right, less people. All those who say carriage inwards have a debit balance. Ah, more people. Lovely. All right, so we're doing this. True or nine? Carriage outwards. Carriage outwards is what? An expense, yes? I am paying for goods to be transported out of my business. It's an expense. What would I do? Would I debit it or would I credit it? Carriage outwards. All those who said credits. Credits. All right, less people. Less and lesser. It's getting lesser. So it is, all right, and I'm going to see if it's correct or not. All those who say debit, carriage outwards, have a debit balance. Very good. I hope all are not just clicking. So I just feel like clicking these thumbs up here, you guys. Carriage outwards is an expense. And the rule with expenses is when expenses, you have to incur an expense. The rule is that they normally carry a debit balance. Let's talk about return inwards. Customers returning goods back in the business. Can I put the word in inside here, boy? Can I do that? And debit usually sometimes really mean in. Credit usually sometimes mean out most of the times. Let me just put it here for the while. If there's any other situation that occur that doesn't involve the in and the out, I'll let you all know. But so far, expenses, you're incurring it. You have to, expenses are debited, receive, okay. This example meant it's coming in and out. All right, so that really didn't work. But return inwards, it means that goods are coming in the business. In the business. Goods are coming back in the business. All those who say debits. Return inwards are debited. Yes. Most of you all are voting yes. So therefore, that is correct. Return inwards are debited. And then we have return outwards. That means it is leaving the business. It's coming out. What is the key word for out the business? Credit. So return outwards are going to be credited. All right. So this is a situation here now. We can use the in and the out. Sales. Sales, we know, is a revenue account. What's the rule with revenue accounts? Do we debit it or do we credit it? All those who say we debit. All right, nobody's saying debit. All right. All those who say sales should be credited. It's a revenue. Excellent. So I put my figure as 120, 320. That's the amount for sales. Purchases. That means you're buying goods. Goods are coming in the business. It's coming in, so I'm going to debit it. You see, there's a difference between sales and purchases. This stock here is our opening stock. How did I know that? Because at the end of the business, they said here in the question, is the 31st of December 2008. So, where is it? This is opening stock. So it's going to be an asset to the business. So we debit it. Motor expenses. We did expenses already. We did like discount allowed. What is the rule with expenses? Do we debit or credit? All those who say debit. Good job. So expenses are debited here. Repairs to premises, that's another expense. So I will debit it. Wages is another expense. So I will debit it. Sundry expenses is another expense. Debit. Rates and insurance, those are expenses. Debit. Premises at cost. Premises, that's a building. That's a fixed asset. What do I do with fixed assets? Do I debit assets or do I credit assets? All those who say debit. Very good. So we will debit our fixed assets. Motor vehicles at cost, I will debit. Accumulated depreciation, because we haven't done too much with this yet. If depreciation is the expense, accumulated depreciation will be credited, but I'll explain that a little later on. Let's look at debtors and creditors. Debtors have what balance? Debtors, debit. Debtors, debit. Creditors, credit. Creditors. You're seeing what I just did there, right? I just sounded it out. Debtors, debit. Creditors, credits. Yeah? We good with that? Let's look at the next item. Cash at bank, cash in hand. Those are assets. That's what we own. Those are current assets. Those amounts will be what? You'll tell me. Debit or credit? All those who say debit. All right? So I'm reaching up to 10. Let's see, most of you are going up. Going up. 11, 12. Good. 13. Lovely. So therefore, I'm going with the first 10. Yes, cash at bank, cash in hand are asset accounts. So therefore, we debit. Drawings, we did that last class. That is debited. Capital, you all know it from last class. It's credited. But I now have to ask all you, long-term liabilities. What do we do with loans? Are long-term liabilities debited or credited? All those who say debit, liabilities, owing, all your loans, liability. Lower all your hands, lower it. Lower them, lower them, lower them. All you know this. Loans. We know loans are liabilities. We know assets are debited, and opposite of an asset is a liability. Assets is what we own, OWN. Liabilities is what we owe, OWE. If we took a loan from P. Holland, that means that's a liability. So I'm asking back the question again. Liabilities. All those who say they have a debit balance. All right. Less people. All those who say they have a credit balance. Good. The numbers are going up. So for those who are still confused because you know who you are, and I know who you are as well, you guys, the best thing to know it and to understand it, go back to the first recording that we did in the summer. I gave you a nice little arrow diagram telling you the normal balances for assets, liabilities, capital, expenses, revenue. I gave you all that the first class. If you missed the first class, that is your foundation class. That first class is your foundation class. Go back over it. I am not going to stress how important that first class was, even though well, I'm sorry, you guys, again, of that. If there was any confusion within the first class, if you're still confused to this point in time, you're staying back and letting me know. But yes, the hands have it, the thumbs up have it. We are going to credit liabilities. Bad debts. Is bad debt an expense? Yes, it means that we're not getting back our money from our customers. So bad debts will have what balance? This is a bonus question, and I'm going to lower your hands, or they're cheating already. Lower your hands. Lower, lower. Right. Bad debt is an expense. What are we going to do? All those who say we're going to debit the bad debts expense account. Oh, Lord. Okay, I couldn't tell who had their hands up first, but yes, bad debts expenses are debited. So we will put debit. It is not credited because it's just not credited. It's not, right? It's an expense. Expenses are debited. And then we have provision for bad debts, which again is our safety net. It's coming out of our profits. It's not, we just putting a safety net. We just having an amount, and I'm going to put it as credit. I will explain that a little later on. But you all, that exercise you all did was excellent. I'm not even going to say it was just good. You all did excellent because you all just did a trial balance of putting in your figures on the debit or the credit side. For your homework, for the last 3 minutes of class, your homework will be to construct a income statement, also called the trade and profit and loss account, up to the gross profit. You all are going to do for me the income statement for J. Jordan. For next class, we're going to be correcting J. Jordan income statement up to the gross profit. And if whoever in class, before I start, tells me the correct figure, I have a treat for you all. A nice financial treat. And I'm being recorded. I just want you all to do your homework. Do your homework, and you all will get a nice little incentive next class. For the first, I'm not going to tell you how much, but if whoever did it first, tell me how much is the gross profit for J. Jordan next class? Well, I get a little treat, a nice little treat. I'll call it the summer treat. Yes? But that's it for class, you guys. Um, if you have any questions or concerns, you could stay back. Let me know. I'm here to answer any questions. It could be for registration. It could be for upcoming academic year, what we have planned to do, or feel free to message me via that number that is in your chat. All right, but if there's no other question, because I'm not seeing anything popping up on my chat, have a great night, and I will see you all for the next session. Bye, everyone.